One of the biggest stories of the moment is that recent inversion of the Treasury Yield Curve. Let's get some common sense and understanding on what that means now, coming from Craig Bolanos. Craig, what do investors need to know?
So what is a yield curve? Well, the yield curve plots the yield of different maturity bonds, usually treasury bonds. And in normal times, a longer dated bond should have a higher yield than a short-term bond. That's common sense. Historically, though, after key parts of the yield curve invert, that's where short-term yields maybe go higher than long-term yields, the economy eventually moves into a recession. Yeah, that's why investors pay attention to this signal. However, it's all about the details, and there's some things investors both deserve and need to know. Sure, yes, past recessions have been preceded by an inverted curve, but by no means does it happen right away. Another way to put it is yield curve inversions have preceded all recessions, but not all yield curve inversions have led to recessions. And historically, when the yield curve does invert, it still takes around 19 months for that recession to develop.
If the yield curve inversion does not signal an imminent recession, what are some other considerations or details that investors need to know?
Well, Angela, that's a great question. And the one thing investors aren't giving enough credence to lately is the short end of the yield curve. In fact, the Federal Reserve came out and said as much. They said, don't fear the short side of the curve. And where that comes from is there's evidence that when you take a look at the 2 to 10, other indicators, they haven't necessarily been the greatest prognosticator for a recession. But when you do start focusing on the spread between the 90-day and the 18-month yield, or what Wealth Management Group tends to look at, the spread between 90-day and the 10-year Treasury, that's been a much better prognosticator relative to recessions coming or not materializing. And when we look today at that spread, the 90 to the 10-year yield curve, guess what? It's at the steepest in almost 5 years. And the truth is, we also have a Federal Reserve who's trying to walk this delicate line. They're trying to be accommodative, trying to tackle inflation while not having a policy error and making us go backwards, aka into a recession. So at the end of the day, when we focus on a very reliable indicator, that 90-day to 10-year spread, it looks like we're doing okay. And I think investors really should focus not on the possibilities, but they should focus on the probabilities. And right now, the probabilities signal no recession in 2022. So what's the bottom line? Review your financial plan. Dial in those investment policy statements. Pay attention to your ADRs. That's your asset allocation, your diversification, rebalancing protocols, and security selection. And we'd love to help. Check us out at our website, investwithwmg.com. I'm Craig Bolanos. We're here to help you get retired and stay retired.
Go to businessfirstam.com for where to see our show on TV.